Here we go. Hi, my name is Chasser Johnson. I am the co-founder of Stockteamup.com and the co-founder of the Stock Boss Up app. I'm here today with one of our just best and top people on the site, Tom Hamilton, a true guru in all sense of the words. I'm going to say it, and he's going to make me want to edit it out, but I'm not going to.
Don't go there. Don't go there.
Tom, thank you so much for joining me today, and tell us about yourself and how you invest and your website, specialrisk.net.
Well, I'll try to take and keep it relatively short because it's kind of boring. I bought my first shares of stock probably when I was about 10, 11 years old, and
Me too.
my father was involved with purchasing stock, and I never will forget him taking me to a broker, and I was kind of mesmerized by all these people sitting around literally and watching this ticker. I mean, this is back in the late 50s, shall we say, not the early 60s to date myself, and it all was kind of amazing. And for the life of me, I still can't figure out why people sit around and were watching a ticker tape, but they were anyhow. So I bought 3 shares of General Telephone, which has since merged into Verizon. And I'm sure the broker basically said, let's put him into something that he's not going to lose a shirt in. So that kind of morphed into going to college. My degree is in electrical engineering technology with a master's in business management. I was, at least until my license lapsed, a registered professional engineer. And I decided basically at that time to, as time went on with the 401 starting to get fairly large, is just to manage that. And I figured there's no one gives you a Red Cross armband for writing a market down. So I've always been, as I say, interested in technical analysis. I'm a member of the APTA, the American Association of Professional Technical Analysts, and as well. So I'm a geek from the standpoint of being an engineer, being background, being yeah, you too, huh? Well, there's hope for all of us, I guess. But so I'm comfortable with technical analysis from that standpoint. But my philosophy really is to combine a certain amount of fundamental analysis along with technical. And I don't want to spend much time on fundamental analysis, so I let other people do it for me. What do I mean by that? I mean, I look at other, I'll say, fundamental gurus, and there's a lot of sources of that. One of the guys who actually is a distant friend is Charles Kirkpatrick. He's written a number of books on technical analysis, but also how to select stocks. And I really use a lot of the public domain, I guess you'd say, scans or filters, call them what you will, that do look at fundamentals. As I say, I don't as such, but I rely on other people's, and whether it's O'Shaughnessy or William O'Neill, or whoever you want to kind of latch onto, and there's a lot of public domain information on trying to find stocks that are interesting to institutional investors, and that's really what I'm trying to do. I'm trying to find stocks that are of interest to institutional investors, because I feel at least they tend to trend longer and steadier. That's not to say that trading IPOs or penny stocks cannot make you money. It's just that I don't want to take and sit around and literally watch the screen all day long. And you're so susceptible now to the old pump and dump. Social media will come up with a gosh, this is the most, greatest thing since sliced bread, buy now, don't be left behind. This is going to be another, I know it's going to be another Amazon, another Microsoft, another Apple, fill in the blank. And I just, I'm not going to buy inexpensive stocks, and I'm not going to buy stocks that don't have a revenue stream. Just not going to. I'm not saying you can't make money there, but that's just not my style. So that's really kind of the bottom line of all that. After I retired from an automotive company at age 55, they wanted to get rid of the high-priced talent, and I volunteered. I basically started my own business, a registered investment advisor. And I want to make very clear, I'm not trolling for clients. I'm in the tail end of my career. Clients are all well and good, but they're also, excuse my bluntness, a pain in the neck, because they're expecting you to make money every week and beat the S&P almost every hour. And if you don't, why not? And, so I have a few clients that are very good, and I tend to want to stay that way. But my philosophy is always, I think, getting better. I think it's very important to know what to buy, but also when to sell. And the psychology of the game, I think, is relatively underappreciated, if you will.
Yeah.
I was reading something the other day while someone said 15% of your time should be placed on entry, 15% of your time on exit, 15% on basically, I want to say position sizing, and the rest of it, almost, well over half of it is the psychology of investing.
Getting some
I thought,
therapy and
yeah,
getting
and I thought to myself, as you get older, and as I know you have a lot of young people getting involved with which I think is tremendous.
We just got another 50 students in yesterday. We helped them get in, so yeah.
But I would totally recommend, don't discount the I'll say the psychological part of it, because your mind will play tricks on you, both entry and exit as well. So anyhow, I could get more into philosophy of investing, but I've spent some time in manufacturing. I'm a big believer in the two P's, preparation and then process control. If you're starting out, spend a lot of time preparing, and then to develop your process. And then you execute your process, and don't be afraid of being wrong, and that's probably the biggest problem with us, Chester, is we're engineers. We're trained to be right all the time, and we build in a factor of safety. We over-engineer, we over-design things just to make sure things will not fail. So we're always kind of drilled in to avoid failure. But in investing, you're going to fail. I tell you that right now. You are going to, if you're not failing, you're not trying. So you just have to know, that this, all of a sudden, this is not the place to be, and it's time to change. So anyhow, I'm doing too much talking. Sorry about that.
It's all good. I like to give an analogy that I just thought up for engineers thinking about investing. You have a machine, right? And you expect that the person using the machine, won't throw a rock at it or won't hit it with a bat. Like, they're not going to hit it with a bat. Doesn't make any sense. But when you're in the stock market, people will just do whatever they want to do, and you can't control it. And they will just throw a bat right onto their portfolio, even if it makes no sense, and you're going to pay the price yourself as the market goes swiftly down or swiftly up. So yeah, I get what you're saying. So,
and it's not easy. You have to be patient. It's gonna take some time to. It's going to take preparation time to develop a technique that works for you. And what's the old saying? There are hundreds of ways to make money in the stock market. Unfortunately, there's millions of ways to lose money in the stock market. So, and one thing for the ladies out there, I totally believe, I think their psyche is more geared to being good stock analyst than really the male, because they tend to be more skeptical of what they hear and what they see, and they want to take time to evaluate it, shall I say? Where a guy will say, "Hey, that sounds good. Let's go.
I've heard
Let's boogie."
I've heard that a few times, with some of my counterparts. Um, yeah, I'm completely with you. I want to note something earlier you said about clients, something that I'd love to share with people. I used to be a hedge fund manager myself, and we really were driven to meet monthly, weekly goals and beat the S&P 500 or beat some other kind of metric,
Hmm.
and that's kind of detrimental to the actual goal, which is to make money, with the caveat that as you get clients, they're going in and out of you as being as being their advisor, so they just want constant return. They don't care if you're going to get a better return in a year. They want it right now. So um, that's a good point to bring up. I appreciate you saying that. I'll also note, I was young enough. I started when I was 11. Also, I was young enough to call the broker to put my buys and sells in when I was 11 years old with my grandfather. So not I wasn't on ticker tape, but I was still making phone calls. That was the only way to do it back then in the 90s.
Yeah. Well, another thing I would kind of give a little bit of a caveat to, especially people starting out, is beware of early success. And the story I'll tell very briefly with that is, I've traded options, I've traded futures. Right now, for clients, I trade stocks, ETFs, and some bonds. But I decided to get involved with futures because, gosh, this is leverage, et cetera. So I did a lot of homework, and I would strongly recommend anybody getting in futures to understand the legal obligations of a future contract. And a lot of people don't understand is you are entering into a legal binding contract to either make or take delivery of whatever it is you're doing. So I said, okay, I'm smart enough to understand that. I'm going to start off small. So I was buying a mid-am contract of soybeans, which is 5,000 bushels, as opposed to the full-size contract, which was 20,000 bushels. And so I figured, well, okay, I'll do that. I was going to buy 5,000 bushels, one contract on the mid-am. And the simple thing the relative strength indicator, ISI, was, breaking out from below 25, and soybeans looked like they were cheap, so I'm going to buy. And lo and behold, before the contract came up, because you have to close it out, because I did not have 5,000 bushels of soybeans to deliver, so I closed it out. And the funny thing about it is that it was very, very successful. So I made a lot of money very quickly, and it was the death of me, because I figured, gosh, this is easy. And that's what kind of concerns me about, especially people in the stock market now with COVID. I'm sure you're aware of it, but there's been so many new accounts opened up because people were at home, had time. The Robinhood phenomena that you're familiar with. But I know every online broker, every one of them, it was just, deluged with new accounts. And the worst thing that could happen to you is to be very successful early on. And that's what kind of concerns me about the market environment. Since March, when a lot of people started doing all this, the market has done nothing but gone straight up. And everybody thinks, God, this is, I'm not so, why go back to work? I can make a lot of money doing this. You've got to remain humble. Rule number one, remain humble, because the market will humble you if you're not humble. So beware of early success and remain humble is another guideline, if you will.
Yeah, I've I've yeah, I've been humbled many times by a few options I've done that have just wiped out to zero. Did not go well. I've never done futures. I did joke with some friends though. When the oil futures became negative sometime in what was it, June or May, where you could actually, like buy a contract and they'll pay you to to take it from you. I was trying to figure out, well, how much oil could I fit in my garage and just take it? Hey, they're negative futures contracts. That was confusing to people. Some people thought that oil was like negatively valued, and I think they didn't understand that the contract itself, the futures contract, was negatively valued. That just meant that they just didn't want to take that oil. They just were fleeing it. That was an amazing time because gas was so cheap. It was so obviously undervalued. I was just thinking, man, should I just pump all this gas and just hold it and then pay, how can I make that happen? But yeah, it was a bizarre time in the futures contract world.
Yeah, if you get involved with futures, you want to know what the legal obligations are, but you also want to be familiar with the terminology contango and backwardation. Uh, and I'll just let it go at that, because you can Google that and get much better definitions than I can give you. But the whole concept of forward delivery and cash is totally different in futures.
Yeah.
Anyhow,
I think of futures, I had an interesting role when I was an operations manager. I am from also manufacturing. I was an operations manager doing future contracts for electricity. They pretty much, the electrical companies, just when you're that big, they don't want to deal with with the market prices of electric. So they force you to make the futures contracts yourselves to speculate on how much electricity. I don't think it was actually a futures contract, but they would make you do a contract where you're obligated to fix the amount of electricity because they don't want to take that market risk on themselves as the utility. So just interesting having to figure that out. And I realized that there was no win because we were in manufacturing. We don't have time to do the analysis. We just had to make a choice and kind of stick with it. The same thing with metal. I used to work at a forging company, and we had to speculate on raw metal shavings that you would resell back to be recycled back in. Pretty much 100% at this point of metal forgings get recycled. I mean, that's how efficient that market has become. But we had to speculate. What's the futures on on these metal shavings?
Yeah.
So
well, and that brings in the whole subject back to investing of what the big commercial people. What they're doing is basically hedging. They want to develop a fixed price, a fixed cost, and that I'll say I don't say indecision, but that unknown will drive them crazy. So what they try to do is use futures contracts to basically at least limit their exposure on the up and down side, if you will. And that's what I did this morning. I basically put on what I'll call a light hedge, just as protection for my client portfolio. And I did do some selling as well. But the whole idea of hedging is to basically go into essentially a synthetic cash neutral position, or at least some, variation of that. Maybe you're not 100% cash neutral. So you're going to take and buy something that goes up when the market goes down, and it offsets, or at least partially offsets, part of the exposure you have with a long portfolio. And the nice thing about that is, you can put a hedge on or take it off typically with one position, one click of the mouse, as opposed to going in and selling 10, 20 positions. That takes time and everything else too. And also it tends to, depending on how much money you're managing or have in the market, it tends to have an effect on the price as well. So anyhow, that's something for folks to just to understand maybe how to employ some inverse funds, if you will, that go up when the market goes down. And they're all over the place. They're in currencies, they're in indexes, they're in commodities. They're all over. Your whatever you want to invest in. So that's something, and that's one of the things too that kind of helped me out after I retired. I figured I needed to take and step the game up a notch. So I took a series of courses from Michael Price, who was a hedge fund manager, still is actually, and his whole thing that kind of drilled into me is risk-adjusted return. Risk-adjusted return. And the whole idea is, yeah, you can make a lot of money, but when you're starting to make a lot of money, there's a little something on my shoulder here that taps me on the shoulder and saying, are you increasing the risk? Do you really understand what risk you're taking by taking on these positions? And so that always kind of helps me kind of throttle back as well.
Did
And
he
that's what I did.
did he talk about like the Sharpe ratio and the Sortino ratios of a risk? Yeah.
Yes,
Yeah.
yeah. So, yeah, and the Sortino ratio was just actually what we spent a lot of time is on the Ulcer index, which is nothing different than the Sortino ratio, really. And then there was a book written about the Ulcer performance index, and it essentially what it is the return divided by in the let's see, the numerator and the denominator had the Sortino ratio or the Ulcer index. So it gives you an idea of what percent return you're getting for what percent of drawdown as a function of time. The whole idea of the Sortino ratio is not just the drawdown, it's the drawdown over how many bars or how many days. As well. So it's the, if you get into calculus, it's the area under the curve, so to speak.
We're not gonna. No. I never talk calculus when it comes to finance anymore. It's too, I start talking about the Black-Scholes equations, and people just like start snoring. So I just gave up on it.
Their eyes glaze over. Yeah.
Just for people that are listening into this, to give a very basic understanding of what we were talking about, because we went a little more complicated, but in the most basic way is when we're doing risk-adjusted returns, the concept is how much are you making versus how much volatility is with it. So even though you're doing great right now, that volatility might kick in and the risk is just too high for your own taste. There's a lot of math that we just went into, but that's the basic premise for someone to start, and it's very important. So supposedly, doing this kind of assessment is very beneficial and a very big part of modern portfolio theory. Yeah, very interesting. I have to ask one question that is biased, but I want to ask it because I think it's very important for people to understand. I'm going to say it at the very basic level, I'm going to categorize you as a day trader. I don't think that's the right categorization, but is that a fair assessment? Pretty close.
No, I'm not I mean, I watch things on a daily basis, but I don't trade. My goal is not to me, a day trader gets in the morning with what they call the opening range breakout, and then gets out from 3:30 to 4. And that's not my style at all. I did that once I retired, and my wife basically said, what is wrong with you?
Turn off the screens.
I was trading the Swiss franc futures. That's another story I won't get into. But I mean, it got to the point where I was scared to death to take and go out and check the mail or take a break for lunch. And I'm kind of going, this is no way to live. So that ended very promptly. But that's what I call day trading, in the morning, out in the afternoon. And I don't do that.
So from your experience being a day trader in the past, how many hours a day should you commit to it? Of trading hours should you commit to actually be successful as a day trader, you think?
Well, what I would do is analysis after the market closed, and then I would basically be there from 9:30 or 9 o'clock in the morning, or watching the pre-market, and then I would take and be there until, watching the screen until shortly after 4 o'clock, just to
Yeah.
see how things wrapped up.
Yeah.
So I mean, you're there in the pre-market, and do I do that now? I admit what I do before I go to bed, about 10 or 10:30, I do look at what's going on in the rest of the world. And people say, what are you talking about? And I said, well, first of all, the S&P futures contract trades uh, virtually 23 and a half hours a day, uh, 5 days a week. And, it opens on Sunday, closes at Friday afternoon. They're kind of going, how can that be? I said, well, it's a futures contract. And I look at what's going on in China before I go to bed. And when I get up in the morning, I look at what Europe is doing. And that will give you an idea of what's going on, for what likely could happen to the U.S. market in the coming, when it opens. It's not, I'm not saying it's foolproof, but it kind of gives you an idea. If you see China tanking and Europe tanking, it's not exactly a positive sign for the U.S. market opening.
Yes.
And a lot of people think that when the Dow closes at or whatever, at 2,800, it opens the next day at 2,100. No. It just because it closed at a number, we'll say, it doesn't mean it has to open at that same number.
Yeah.
Things happen while you're sleeping.
Yes.
Anyhow,
absolutely. Yeah.
It's more complicated than that.
Yeah. I asked the question about the number of hours just because I'm on a mission to tell people, if you're working 9 to 5, you can be successful as a long-term investor, but you're not going to be successful as a day trader because you're not in front of the screen while the stuff's happening. Unless you want to stay up all night, day trading, I guess, the Chinese and Asian markets, then stay up all night doing that, but it's just not going to work.
Well, another thing too is people have told me, says, well, I can do that because I have a stop in. So I'm okay. I have a buy stop or a sell stop, and I'm okay. And I'll tell them, I said, it all depends on what type of market you're trading in. And one of the things I learned very quickly is I had a sell stop in a country-based ETF. And I soon found that what would happen, the market would open at 9:30, and the first 5 minutes, I was the market. I had a sell order in. I was the market.
Yep.
And lo and behold, what happened is, they came in and hit my stop. And that's the other thing I do too is institutional investors will say the big guys, the smart guys, are not going to be trading illiquid securities. They're not. And I've done some lectures to the AAI, American Association of Individual Investors, which are typically a bunch of old white guys who've got a lot of money, who are trying to take and figure out how to take and make a lot more money, and typically not willing to spend the time on it. So they look for gurus. But I told them, I said, when a institutional investor wants to take a position, and we'll say, not necessarily an Apple or Amazon, but something that's less liquid, that's down there a ways, but still is like a Shopify or something like that. That is an internet stock that's got some volume, but it's not really a household name. Okay, Fidelity comes in. I want to take and buy maybe 100,000 shares. So they go in there, they type in buy 100,000 shares at the market. Oh my God, that's going to move the market. Oh, okay, let's put a limit on it. No, they don't even do that. And I told them, I said, what they do is they put it into an algorithm and they start metering it in. They may meter it in over the day, several days, a week. They take positions over a period of time. And, another terminology to get familiar with is VWAP and TWAP, volume weighted average price and time weighted average price. And that's how these guys measure their effectiveness of getting a good price, is with the VWAP and TWAP. But I mean, we're getting geeky at this point. But my only point is that, you know, the big guys are going to be trading things that they can get into
Yep.
and not push the price up. And they want to be able to get out without pushing the price down, because they can't sell at the market.
Yeah.
Are you kidding? I mean, there's, you know, if you look at a level 2 screen, and that's one thing that people should be familiar with, is you can see the buy and sell orders at what price. And there's some shenanigans going on there that we won't get into either, because a lot of these prices and orders are out there for feelers. They're not out there for actual prices, but that's
Oh,
a
yeah.
different story.
Yeah.
I won't get into that.
Yeah. I will say, you know, for my hedge fund life, two things related exactly to what you said. We did momentum trading on country based or regional based ETFs, and we never traded at 9 o'clock or or 9:30 or at 4 o'clock or 15 minutes in that time frame, because we were going to be the market makers, and we were going to be the market, and we were going to get eaten alive. The other thing is we did trade with algorithms too. When we were moving about $1 million, that was enough for these small ETFs to really move the price. So we would do exactly what you said as also. So it's very important, even with a small hedge fund, to try to do your trades with an algorithm to try to ease it into the market.
But just, I guess the bottom line is, just because you have what they call a resting stop, you have a stop in the market, is that a savior? In some cases it might. If you have something that's ultra liquid, like an Apple, Amazon, Microsoft, fill in the blanks, that's probably going to be, I would say, probably going to be okay. But when you get to something that is doesn't have the volume, and that's one of the first thing I do, not to get into philosophy, is I look at what is the price, because typical institutions are not going to buy anything less than $10, just because they can't move. And I'm looking at volume. What's the 20-day volume on this? Does it have the liquidity? And I also look at dollar volume, which is basically the price times the volume. But does it have? I don't want to be more than 1% of the dollar volume. I don't want to be, just because I don't want to move the market. Now, I have an institutional account at Interactive Brokers, and they have a host of algorithms for me to use to get the best possible price. And when I put an order in, they put the order in on 8 different exchanges. So if I buy 5,000 shares of Microsoft, I might get hit for 100 shares on the New York, 1,000 shares on the BATS exchange. I might get hit for a few more thousand on ARCA, et cetera, et cetera. And they might even go into a dark pool to pick up some. Yep. So, you're playing in the deep end when you start to get involved with institutions. But at the same time, you have one big advantage. You're small. And if you have the knowledge and you're small, you can get in and out and run rings around them before they can't, because they can't get in and out fast. And that gets me into the whole idea of Wyckoff theory and reading charts. The whole thing is trying to read when the smart money, the institutions are getting in, and when they're trying to distribute, when they're trying to get out, because it'll take them days to get out. And that's a whole different subject. But there's just a lot going on there, because a lot of people out there are trying to pick your pockets, the small guys. I mean, there is no loyalty. That, well, hey, be nice to them. No. They don't know who you are. And that's the nice thing, is whether you're black, white, Asian, or whatever, the market doesn't care. You've got an order in there, and it's going to get executed, or at least given the same amount of attention, regardless of who you are. But the bad news is if you don't have the knowledge base in there, they'll also take advantage of that as well.
Absolutely. Thank you for that. That was a good way to end the interview. Tom, thank you so much for joining me today. This has been very insightful, and we need to talk again and just continue being geeky and nerdy about, about investing. We need to do this more often.
Yeah, we just scratched the surface here.
Well, thank you very much. Check
Welcome.
out Tom's site. It is
Dash.
special-risk.net.
Right.
He is one of our top gurus. Look for Yoda, and
Yoda.
and check out the Stock Boss Up app and stockteamup.com. Thank you so much.
You're quite welcome. Thank you.